Hello, vetted VA community. It is Helmer here with your weekly mortgage market update. This week, I am joined with our guest, Jerry Holland. Jerry, thanks for joining us. Please take a minute. Go ahead and just tell everybody a little bit about yourself and where you've been since second grade.
So I'm Jerry. I'm a veteran myself. We work with New Point Lending, and about 2.5 years ago or so, a good friend of mine is a moderator on here is Jimmy Hobson was telling me about vetted VA, and we could see early on in the process that we needed something for veterans to education platform and stuff. And every avenue we went to was sort of just a money grab until Jimmy told me about vetted VA, and got with Chris and talked to him a little bit, and he's told the picture of what vetted VA was doing and how the other moderators came together to help veterans. And so that's kind of where we came in to, I guess coming into the vetted VA, why we're here, just another outreach to help my brothers and stuff. So.
Awesome. Well, thank you for joining us today. Remember, y'all, if you're here live, go ahead and take a minute. Let us know. Say hello in the comments. I do see actually just 9 of you on today. Let me know your name when you do say hi in the comments. Let me know if you're a professional or a consumer, because all I get to see is something like Facebook user. We don't get to see who you are. So if you are watching on the replay, do us a favor. Give us a hashtag replay. Let us know that you were here. Remember, we do monitor this post all week. So if you have any comments or questions and you are watching on the replay, go ahead and put them on the post. We will be glad to answer them. Don't be afraid to tag us, either Jerry, myself, or another moderator in the comments, and we'll be glad to answer any questions that you guys have. So, like I said, if you've got questions or comments, let's go ahead and hear them. Otherwise, we've got Thomas Sloan on. He is an MLO, so he's a mortgage professional. Thanks, Thomas, for joining us. We got Matthew Tittle on as well, and it looks like he's got a vetted VA tag, so it looks like he is also a professional. So great to have you guys here. If you guys have any questions or anything you guys want to add in the comments, please feel free. And consumers love to get your feedback as well. So let me go ahead and flip that one off, and let's start off, Jerry. Let's just do a quick rate recap. Let's talk about what happened last week with interest rates. I'll tell everybody a little bit about what I saw, and then we'll turn it over for you and see if that sounds about right to you, or if you saw anything different or anything you want to add. So first thing is we did see rates move slightly higher last week, and as a consumer, that generally means you may see rates that might be about 1/8 of a point higher. So if you were getting quotes of 5.75, you may now see a rate of 5.875. Again, these are just made up numbers, just a rough estimate that you may see. This is not an offer to lend. And, your unique rates are going to matter on your unique situation, which is why you want to talk to one of our vetted VA professionals, and they can help you to figure that part out. But basically, we did see rates move up a little bit higher last week. I want to show you guys the fancy little charts, and we'll show you why that actually happened. So mortgage rates are actually based on what happens in the bond market. And this is a chart called the Japanese candlestick chart. And when you see these green bars that move in an upward direction and trend upward, this is good for mortgage rates. This means mortgage rates actually can improve a little bit. When you see them turn red and they go down, that's actually bad for mortgage rates on this chart right here. So over the last week, we've seen a little bit of downward movement. And most of that is due to traders just taking the last couple of weeks of the year off. They generally do that every year. They take off the last couple weeks of the year. What happens, we get very low trading volume, and we call that illiquidity. So there's not a lot of money flowing in trade right now. What that does is it kind of exaggerates any of the movements that we see. Sometimes we'll see a little bit of a negative movement here. And that's what led mortgage rates to just kind of creep up about 1/8 of a point over the last week or so. Not anything that we need to get overly panicked about, and it's certainly not a long trend, but you may see that if you get a rate quote last week and you refresh that rate quote this week, you may see something like that. So that's my take on it. What about you, Jerry? What have you seen in the last week?
We kind of been in the same boat, just seeing the mortgage rates. I call it the flat line. So more or less towards the end of the year, we know we're in the holiday season. Everyone's taking time off, and there's not any huge reports coming out, even though we had a couple last week, right? So there's no real market joggers coming in. So we've seen, just like you said, we've seen rates go up about 8%. I expect to see them fluctuate up and down until the beginning of the year. Once we start getting in, everybody starts waking up again and re-entering the market. So
Awesome. Well, that brings us right into that next conversation, which is kind of a rate forecast. For me, I think rates have a good chance of improving a little bit next week. We call it a range. So mortgage rates tend to move up and down within a certain kind of what we call a high point and a low point, or a ceiling and a floor. And they will move. So right now, let's say for VA rates, that may look that you're seeing VA rates that might be as low as, say 5.75, and then they might move up to 6% and back down to 5.75. So you're going to see that kind of movement. And we've got a good shot of seeing a little bit of improvement next week, just when traders go back to work, and we do see the kind of things settle into an equilibrium of where they belong. And rates generally for VA rates, again, I know many of you just want a kind of an idea so you can compare it to your scenario. If you were looking at a rough idea, you're going to see rates in the high fives to the low sixes, depending on your credit score and your unique situation. And again, talking to a VVA professional is the best way to find out a little bit about your situation, as well as shopping around. And when you do shop around, make sure that you're comparing apples to apples by shopping at the same time frame. So you don't want to compare a rate quote you get today to a rate quote you got last week, because, like we said, rates change. So I think things will stay where they're. I don't think we have to worry about rates moving up very high or getting back into the sevens for sure. That's where we're at as of today, based on economic conditions. Jerry, your turn. What do you see? What do you think's happening?
So again, we're just in step with each other. I'm actually telling my clients, the ones that locked into higher rates last year, at the sevens and stuff, I'm like, don't rush to refinance. Ride this out a little bit, because I see rates are going to start taking a dip in January, especially towards the end of January. And as we start getting more inflationary numbers out, showing that inflation is in fact coming down. And then we get the Fed window coming on February 1st, where they're going to raise interest rates again for the Fed window rate and stuff. But all this stuff is good to help control the economy and stuff. And so I'm encouraging people, I was like, wait, don't refinance right away. Wait until mid next year or so before you start thinking about that to really capitalize on the lower rates. But I agree with you. I think rates are coming down. I think our housing market's still stable, even though we've seen the decrease coming in with the purchase prices and stuff. And my fear is, and you'll have to tell me your thoughts on this. My fear is, once interest rates starts coming down, we're going to have more buyers coming into the market. And once those buyers enter the market, we're going to see the housing prices rise a little bit more. And so the lows that we have right now will actually start going up, and maybe we'll start seeing some of these seller credits that we're getting go away. And I'm wondering, I don't know. I just think about the 2-to-1 buy downs. If we're going to start seeing maybe those go away as product options in the future. So
Yeah. So let's dissect. Those are all great points, Jerry. Let's dissect those a little bit, and we'll use this Wall Street Journal article as kind of a starting point. So somebody that's reading the headlines, they may be reading, the Wall Street Journal like myself, and it says home prices fell in October for the 4th straight month. And this is almost like somebody walking through the streets, screaming, "Bring out your dead." Everybody's afraid that, this is the beginning of that crash, that housing bubble, and all of that. And the reality is, it's really not. What we're seeing for home prices falling, if you kind of dig a little bit deeper, they fell 0.5%. They fell 0.5%. This is not a 10% drop. So this is not a home that was $400,000 that has lost $40,000. This is a home that was $400,000 that lost $2,000. So this is not the beginning of the housing crash, people. And Jerry, you brought up a very good point. A lot of the reason that we're seeing this, and we've talked about this before, and I'll throw this up, on here. There's a current home buying advantage because rates have gone up. And it's led to a condition where we've got a little bit more inventory. There's a few more homes on the market, so there's less bidding. They're not going for crazy amounts over asking price. In fact, you can go ahead and get what we call a seller concession. Jerry, just kind of in layman's terms for the consumers out there, what is a seller's concession, and what would they expect? What would they ask for one?
So a seller concession, like I view it in layman terms, is the seller is trying to incentivize you to buy their house. They're going to take money and give it to you to apply towards your closing costs. And so that's a favor towards you, right? And if you're a veteran, that money, if you have all your covered costs covered, then that seller concession can also be applied to pay some of your personal debt. which is a benefit of the VA loan. But in layman terms, that's why I see it as.
Yeah. And that's usually, sellers don't necessarily want to give up money. If I'm a seller and I'm selling my home for 400,000 and Jerry says, well, hey, I've got a few $1,000s worth of closing costs that I'm going to need to pay. Would you sell it to me and I'll give you the 400,000, but would you give me 3,000 back and use that towards my closing costs? Now, why would a consumer want a seller concession instead of just lowering the sales price?
For the long term, it's a little bit better because let's say that someone's coming in, they don't have the funds to cover the seller concessions, right? And we have a 100% VA loan. And so if they're going to give you the seller concessions, you can legitimately walk into a VA loan without bringing any money to the table. And
right.
So yeah, there's just different situations that'll cover that.
Yeah, so they're able to borrow. As a veteran, you're able to borrow that 400,000. The seller's going to give you $3,000 towards those closing costs. Now you're not bringing any money. Whereas if they lowered the sales price to $397, you'd still have to bring $3,000 to the table. So you're basically able to finance a little bit more because you're financing that full sales price, and the seller concession is used to help offset your costs, or like you said, even to pay off some debt, which can help with payments and things like that. So deeper questions on those should always, again, they're great conversations to have with a VVA professional. You can ask about any of those in the group. If you're not working with anybody yet, you can ask about them in the Facebook group, and our moderators and VVA professionals will be glad to go into more detail for you on those. But yeah, definitely those things are there. And the other thing that you had said was, when interest rates do go back down again, which let's kind of take a look and say, okay, well, do we think they're going to go down? So what do you think 2023 is going to bring for rates and the housing market? What do you think we're going to see over the next year?
Yeah, that's a hard prediction. Because like in 2022, people are projecting that the interest rates would go as high as 4.5%, 5%, right? And then there we are knocking on 7% towards the end of the year. And so it's kind of hard to predict how low they'll go. And so I don't want to go there, but we do want to say that as inflation goes lower, and we're already seeing signs that inflation's getting lower, right? The Fed's window rate, they're raising it by 75% in October, and then 50% in December. And now we're seeing the 25 bips in February is what we're projecting. But as inflation starts coming down and the Fed starts taking these economic easements or what have you, and we watch the rest of the economy, we see that the interest rates will be trending downward. And so my personal opinion is we'll probably see around 4% by summertime. But again, anything could happen. We had the war in Ukraine pop in last year, and that just sort of threw things up in the air. So
yeah, as a professional rate forecaster, I have some instruments that I use, to make sure that I'm on the ball. And so I basically, if my opinion of mortgage rates are going to drop, you can rely on it, is what it looks like. And I think that I better not tell you now, but it looks like my sources say no. See, I'm sorry. Yeah, it looks like my sources say no. They're not going to be. Yeah, no. So all kidding aside, and of course, that's what some people think it does come down to is a bunch of magic 8-balls. But no, actually, it's economic conditions, as you pointed out, and the Fed activity. I think 4% might be setting an expectation that's a little lower than I think. I think we're going to be in the 5s. Generally what's going to happen, as you pointed out, and I'm actually going to bring this up since you talked about this. So these are Fed futures, y'all. So what we're looking at, and I've talked about this on some of our past, shows, is mortgage rates are already reacting to the speculation of what the Fed is going to do, weeks and months from now. So the mortgage market does not necessarily change when the Fed takes the action. It's when everybody thinks the Fed is going to take the action. And that's why we monitor what's called Fed futures, which is basically placing bets on where do the markets think the Fed is going to go with their policy rates. Now, right now, the Fed policy rate is at 4.25, and we've seen that go up from 0 through the pandemic. So, I mean, we've seen a big jump. That's why mortgage rates have gone up. And what, as you pointed out, we're really seeing a strong expectation at the February meeting. It's the end of January, the 1st of February, that we're going to see a 1/4 point rate hike or a 25 basis point rate hike. And that would take that policy rate to 4.25. And then there's some outliers that think that they may have to go a little bit higher to keep that pressure on inflation. And they may go to 4.75, which would mean a 0.5% rate hike. But by the time we get later into the year, and all these dates across the top are different Fed meetings, and the Fed meets about every 6 weeks. So we've got the March meeting. Expectations are that we'll be up to 4.75, and this is what we're currently seeing is the peak at the top point, or what they call the terminal rate, where the Fed funds rate is going to go to. So expectations are we'll be at 4.75 by March. By May, it'll stay there. June, it'll continue to stay there. July will continue to stay there. But when we start getting to that September meeting, all of a sudden it's that last time that we see a very strong 4.75, because by November they start to expect that maybe we'll see those pull down. So what that means is markets are currently pricing in this idea that the Fed is going to see inflation really start to slow down, and that they're going to keep that Fed funds rate up high for, most of next year. But by the end of next year, they're going to need to start to lower it again. And the reason they would need to lower it is if the economy is struggling and if we're in a recession and they need to jumpstart things again. So what they're doing right now is they're really applying the brakes, and eventually we know they're going to have to press the gas pedal again. And that's what lowering rates will do. So I think that we could see mortgage rates, they'll react when we see inflation start to really drop. Hopefully that starts to happen by the middle of next year. We're seeing signs of it now, but not as convincing as I think everybody wants to be. And, we're going to see a labor report come in next week, and we'll talk about that more next week, but we're going to see a labor report come in. And those are the two elements that the Fed is looking at. They're looking at inflation and the labor market, because when the labor market is strong, as much as we want to see people with strong jobs making a good income, but what happens is it's all supply and demand. So if people are making really good money, if wages go up, it creates what's called wage inflation. So people have more money to spend. The price of goods goes up because there's less supply and more demand, and that's just natural economics. So you see inflation continue to take that. So the Fed is looking for the labor market, which is currently really solid, especially in some certain sectors like hospitality and restaurant, retail. They're looking for that to slow down a little bit. So if we do see some signs of all those things happening, I think rates could fall into the lower fives. But I think that for most of 2023, I think if being in the fives would be a really good place to be. That's my take. Anything that you want to build on or add to on what I was just chatting about, or?
No, that's all great. I mean, it's that your insight there is awesome. So,
okay, good.
I do agree though. We're starting to see the job market slowly loosen up, and we're seeing more and more layoffs coming. And like in my area here in Utah, we're a huge tech industry. They call us the Silicon's slopes, the little buddy of Silicon Valleys, right? And it's like we're starting to see some of those techie jobs where they're having little layoffs here and there to just ease the burden of what's going on. But
it's funny, and I'll come back to this article, but let me see if I can find it within a moment. But on the Wall Street Journal, it was I did see an article that talked about a lot of those tech jobs. They were not having trouble getting those jobs again. Finding new jobs was actually, and it was an article. I found that article interesting. So a lot of things on here, y'all. So not seeing that, but I did see something about that. But going back to the housing market, we talked a lot about rates. Do you think that the housing market? Do you just talk a little bit more? Do you think there's a fear of a crash or a bubble? Do you think that home prices are, here it is, laid off tech workers quickly finding new jobs? So that I had seen that.
Yeah. So I don't think the housing market's in any trouble at all. I mean, like history, well, I mean, you can go back and I'm sure you got graphs showing that after most recessions, or during most recessions, the housing market thrives, right? I want to say, I think it was today we had reports come out talking about the late rents or late mortgage payments, and also for foreclosures, I believe, came out showing that it's such a minute portion of our population that falls in that. I mean, it's so small. We have so strong, or our housing market's strong. There's a lot of equity built into our housing market as well. And so I don't see it hurting us.
Yeah, no, and I agree. And that's why I'll highlight a couple of things in the article. Again, the headlines get clicks, and newspapers need clicks. They're selling all this crap. You could tell I'm looking at New Kitchen stuff. They're selling all this stuff. They're selling ads. So, which I really like this Viking stovetop over here. So anyway, they're selling ad space. So you see a headline like home prices fell in October for the fourth straight month, because it's a very catch your eye kind of a thing. It's much less of a headline to say on a year-over-year basis, home prices rose 9.2% in October, but that's down 10.7% from the month before. So they're rising slower year over year, but they're still rising. And then month over month, again, it fell 0.5% in October. And since June, and we basically identified to be the high, home prices dropped an average of about 3%. So again, on a $400,000 house, that's 12 grand, and it sounds like a lot, but it's really not. That's not a lot of that's not a lot of money. To call it a crash. 400 didn't turn into 150 or 200,000. So there's a big difference there. So I don't think there's anything we have to worry about. I think if you're buying a home now, that's the question that we get all the time is hey, are we in a housing bubble? The answer to that is a clear no. Is now still a great time to buy a house? Jerry, I'll let you end with that and we'll wrap up. Why do you think now is still a great time to buy a house?
So I think the present time is always the best time to buy a house, right?
I agree.
When I'll tell you a story about a client of mine. He decided to wait. He was going to save his money and come up with a bigger down payment. And he waited 6 months. And during that 6 months, he got a $2 an hour pay raise and stuff. And it was at the beginning of when the interest rates were rising, right? And so by the time he was ready to buy a house, he couldn't. Instead of buying a $340,000 house, he can now afford a $315,000 house. And so I think waiting is going to kill you if you think that's your long-term plan. Because like you say, the housing market is going to continue to rise. It's not going to rise as quickly as we saw in 2020, 2021, or 2022, but it will continually rise. And it's just a great, solid investment. And one of the slogans people are saying now is buy the house now, get into the interest rate where it's at, and just refinance it later. Because we know they're coming down. They have to hit the gas pedal to speed up the economy once it's needed. And inflation's coming down, and that's the key indicator of that drives our interest rates and stuff. And so once we get there, it's going to be a solid investment for you.
Yeah, absolutely. I agree. Yeah. And the one thing to remember too, for everybody, we've been spoiled. We've seen rates that were in the 2s and 3s percent range. And if we see those again, it means that we are in a world of trouble, because the only reason we saw those was because of the reaction to the COVID pandemic. So I don't want to blame it on the COVID pandemic itself. It was the reaction to the COVID pandemic, shutdowns and economic stimulus and all of that. It's not likely that we will see those rates again, possibly in our lifetime. It's a sign of a very problematic economy for us to see rates there. Rates will more naturally, before the pandemic, we saw rates in the 4s, and the 4s may come around again. It may take a little while, but we may get to the 4s. The 5s are very natural. That's where rates could be. The 6s are very natural, but we may get it down as low as the 4s if the economy does get into a deeper recession and if the labor market gets in a lot of trouble. I don't necessarily know that we're going to see that heavy of a recession. That one really is to the magic 8 ball. I've read reports and lots of intelligent people that say it's going to be a terrible recession. And then I've seen some that say, well, we may not even notice it. You know, I mean, I've really seen that. What about you, Jerry? Have you seen that kind of, you know, spectrum
we always
as
see
well?
the doom and gloom pictures once they come up,
Yeah.
right? Because like you say, that's what sells. I'm kind of with you, but I live in my own little bubble as well, right? Because I just went out and got a Happy Meal the other day for my kid. I think I spent like $9, and you know, it's mind blowing. It's like, whoa, what just happened? So a lot of my purchasing and stuff is done inside my little bubble, and so I haven't really seen how much the inflation and everything is affected, or the housing.
Yeah.
But for me, I say if you plan ahead, if you know what's coming, anything that comes isn't going to be as bad. It's just you have to foresee it and react to it before you have to react to it. If that makes sense.
Yep. So. No, it does, and that's a good point to end it on. So, well, everybody, we are at the end of today's show. Thank us again for joining us. Remember, you can join us next week. We do this 12 p.m. Eastern time. You can go ahead and do the time zone dance to figure out what it is in your neck of the woods. What is it in Utah, Jerry? Is it 10 a.m.?
Gosh, why do you ask me the hard questions?
Are you in Mountain Time? Are you in Mountain Time? Yeah. So see that. So, you know, but we're 12 p.m. Eastern time. We do this every week. You guys are here. If you are watching on the replay, don't forget to go ahead and give us that hashtag replay. We appreciate it so that we know who's watching and that you are watching. If you have any questions or comments, go ahead and post them. We'll be glad to answer them for you. Otherwise, you know, someone said, thanks for the information. You are welcome. We're always glad to do this and keep you informed. That's what we do here at Vetted VA. So, all right, everybody. Well, Happy New Year. We'll see you again in 2023. Jerry, thanks again for joining us.
We'll see ya.
Bye-bye, everybody.